warriors of price action and guardians of fundamentals. Welcome back to Retail Recon. Today's mission targets a core decision every investor faces: ETFs versus mutual funds. Both get you exposure to entire markets without picking individual stocks. But don't be fooled. These two vehicles operate very differently in the field. Choose the wrong one and you're bleeding capital through fees, taxes, and poor execution. Mission objective: understand when ETFs give you tactical precision, when mutual funds serve a defensive role, and why most retail operators should lean heavily toward one of them. What ETFs and mutual funds really are. Think of both as transport units moving your capital across the market battlefield. They carry similar cargo, diversified baskets of stocks, but they deploy very differently. An ETF, exchange traded fund, is your armored convoy. It moves fast, trades all day, and reacts in real time. Just like a stock, you can enter or exit positions whenever the market is open. Prices shift second by second based on supply and demand. Costs stay low, usually between 0.03% and 0.10% annually. On a $10,000 position, that's pocket change. A mutual fund is more like a scheduled transport truck. It moves once per day after market close at its net asset value or NAV. No intraday control. No reacting to battlefield conditions. You place your order and wait. And it costs more. Typically 0.5 to 1.5% per year, sometimes with upfront fees that immediately reduce your capital. Key takeaway: ETFs give you flexibility and low cost. Mutual funds trade control for simplicity but at a price. The main battlefield difference is execution. This is where strategy becomes reality. With ETFs, you have full control, real-time pricing, limit orders, stop losses, even options on major ETFs. If the market turns against you at 7 minutes past 10, you can act immediately. Mutual funds, you're locked into delayed execution. You place an order during the day, but it fills at whatever price the market closes at. No precision, no timing, just exposure. That delay can cost you, especially in volatile markets where price swings are aggressive. Costs are the silent capital killer. Let's talk damage over time. Imagine deploying $10,000 into the S&P 500. With a low-cost ETF, your annual fee is minimal. Over 20 years, your capital compounds efficiently. Now take a typical mutual fund charging close to 1%. That doesn't sound like much, but over decades, it compounds against you. The result? Thousands in lost capital. Not from bad investing, but from friction. Add in potential sales loads and you're starting the mission already down on resources. In long-term warfare, cost efficiency wins battles. Let's talk about taxes. ETFs are built for tax efficiency. They use a structure that allows internal transactions without triggering taxable events. Translation: you don't pay taxes until you decide to sell. Mutual funds operate differently. Managers buy and sell constantly, and those gains get passed on to you. Even if you didn't touch your position, you could still get hit with a tax bill. That's capital leaving your account without your command. ETFs open up your playbook. They allow sector exposure for targeted deployment. You have inverse ETFs to benefit from downturns. You can use leveraged ETFs for aggressive positioning, and you have options for defined risk strategies. Mutual funds, limited flexibility. No intraday control, no advanced strategies. You're trusting a manager, and statistically, most don't outperform the market over time. You're paying more for less control. But mutual funds aren't obsolete. They just have a narrower role. They work well when you're in retirement accounts where taxes are deferred, you're investing passively for the long term, and you want automated hands-off exposure. In these cases, the lack of flexibility isn't a weakness, it's irrelevant. But outside of that, they're rarely the optimal tool. Let's now go through some common mistakes. Mistake 1. Legacy thinking: just because something worked decades ago doesn't mean it's still efficient today. Mistake 2. Trusting star managers. High fees for average performance is a losing trade. Mistake 3. Ignoring liquidity in ETFs. Not all ETFs are equal. Stick to high volume, tight spread instruments. Mistake 4. Overlooking tax drag. Taxes can quietly erode your returns if you're not paying attention. Let's recap this mission. ETFs are your precision weapon. Fast execution, low cost, tax efficiency, and tactical flexibility. Mutual funds are your defensive transport. Slower, more expensive, but useful in controlled long-term environments. For most retail operators, ETFs dominate the battlefield. On our next episode, we will go through some of my option trades. You will see how the same setup can result in different results. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.